Real estate real estate license exams for dummies. Part 5. You want how much? Evaluation and financing of real estate. Chapter 17. Investing in real estate. Review question and answers. Actual math calculations on this information may or may not appear on the exam, but the exam writer is expecting you to be able to explain in words what each investment term means and, if relevant, how it's calculated. Question number 1. Real estate is considered A. A no-risk investment, B. A liquid investment, C. An investment that requires little management, D. An investment that requires good professional advice. Correct answer is D. An investment that requires good professional advice. Real estate isn't considered a no-risk investment, especially because of the dependence on the unpredictable future market conditions. It definitely is not liquid, meaning that you can get your money out of it quickly. Its non-liquidity is generally considered one of the major disadvantages of real estate investment. It does require some kind of management, even if you hire a professional to handle your day-to-day. Question number 2. The act of using borrowed money to extend the profitability of your investment is called A. REIT, B. A capital gain, C. Leverage, D. Pyramiding. Correct answer is C. Leveraging. The tricky answer here is pyramiding. Pyramiding is using the appreciation from one investment to make more investments. Leveraging is what makes an investment more profitable because you're using less of your own money. A real estate investment trust, REIT, is a type of stock investment, like a mutual fund that invests in real estate. A capital gain is the profit made by buying a piece of real estate at one price and selling it at a higher price. Question number 3. I put a down payment of $50,000 down on a $200,000 investment property. In 5 years, I sell it for $225,000. The fact that my profit is 50% is a result of A. Return on investment, B. Leverage, C. Tax benefits, D. Depreciation. Correct answer is B. Leverage. The question puts some numbers to the leverage issue without you having to do the calculation. In case you've lost, you divided the profit of $25,000, the $225,000 minus the $200,000 by the $50,000 down payment to get 50% profit. Return on the investment is incorrect because the example talks about the money I made above and beyond my original cash investment. Nothing in this example deals with taxes or depreciation. These items are presented in the most real estate investment, but examples don't give you any information about them, so tax benefits and depreciation are also incorrect. Question number 4. Making money by selling a property for more than you paid for it is called A. Capital appreciation, B. Return on investment, C. Cash flow, D. Tax credit. Correct answer is A. Capital appreciation. Don't get confused here with the term capital gains. Essentially, capital gains and the capital appreciation refers to the same thing. However, a capital appreciation describes what the question is asking, and the capital gain usually describes the same thing for income tax purposes. Return on investment is a return of your original investment money, capital, not any additional money you make, which is why in return on investment, cash flow in general terms is used for the annual return on investment after all expenses, including debt service, are paid. Nothing in this question refers to taxes, so you can eliminate the tax credit right away. Question number 5. After calculating capital gains, what is subtracted from the selling price? A. Depreciation. B. Capital investment. C. Operating expenses. D. Adjusted basis. Correct answer is D. Adjusted basis. The adjusted basis is the original purchase price of the property plus any capital improvements minus depreciation, and it is used to calculate the capital gains. Question number 6. A pro forma for a vacant building would use A. Scheduled rent. B. Debt service. C. Market rents. D. You can't do a pro forma for a vacant building. Correct answer is C. Market rents. You need to remember this. Debt service isn't used because it's more specific to the property owner than the property itself. Remember that scheduled rents are used as part of the overall investment analysis, but are not usually used in a pro forma unless long-term leases are in place. In this case, a vacant building, there is no leases. Question number 7. A few years ago, you bought an investment property for $100,000. You made $10,000 worth of improvements and took $6,000 in depreciation. You sell the property for $120,000. What is your capital gain? A. $20,000. B. $16,000. C. $10,000. D. $4,000. Correct answer is B. $16,000. Here are the calculations. $100,000 purchase price divided by $10,000 capital improvement. Plus $10,000 capital improvement minus $6,000 depreciation equals $104,000 adjusted basis. $120,000 selling price minus $104,000 adjusted basis equals $16,000 capital gain. Question number 8. You exchange properties with another person. Your property is worth $200,000. Her property is worth $250,000. You give the other party $50,000 in cash. This cash is A. A boot and is taxable to her. B. A boot and is taxable to you. C. Capital gain and the tax is deferred until you sell your property. D. Capital gain and tax is deferred until she sells the property. Correct answer is A. A boot and is taxable to her. A boot is money or personal property given in exchange for when the properties are not equal in value. The person receiving the boot pays the taxes on it. Question number 9. You own an apartment house. The potential annual gross income is $40,000. The allowance for vacancies is 5%. The annual operating expenses is $10,000. The debt service is $12,000 per year. What is the net operating income? A. $16,000. B. $18,000. C. $20,000. D. $28,000. Correct answer is D. $28,000. You have to remember the order of how to calculate a net operating income on a pro forma. You also have to remember that you don't use debt service in this calculation. Exam writers sometimes give you information you don't need. Remember to be careful whenever you get monthly numbers because all of these calculations have to be in annual figures. The calculations is as follows. $40,000, the potential gross income, times 0.05, the vacancy allowance, equals $2,000 vacancy and collection loss. So $40,000, the potential gross income, minus $2,000, the vacancy and collection loss, equals $38,000 effective gross income. $38,000 effective gross income minus $10,000 operating expenses equals $28,000 NOI, net operating income. An amount of money that the government allows you to deduct from taxes. Question number 10. The amount of money the government allows you to deduct from taxes owed on a building's income is called A. Depreciation, B. Cost recovery, C. Tax credit, D. Tax deduction. Correct answer is C. Tax credit. You have to read this question carefully. Depreciation is deducted from income, not from taxes owed. Cost recovery is another term that sometimes is used to mean depreciation. A tax deduction is deducted from income. And that was part 5. You want how much? Evaluation and financing of real estate. Chapter 17, investing in real estate. Question and answers. Thank you.